Welcome this afternoon to this webinar that Nother and Citrin are presenting, which is entitled Maximizing Loan Forgiveness through the PPP and the calculator methodology that we have devised in conjunction with the PPP legislation that has come out over the last number of weeks. It's our pleasure to present to you. There's three of us today. My name is Shannon Zollo. I am a corporate partner at Nother. I lead the M&A practice. I'm here together with one of my corporate partners, Josh French, who's worked with me extensively on the PPP advisories and the PPP Loan Forgiveness Calculator. And we are also joined by Bonnie Simmons, who is a partner at Citrin Cooperman, a well-respected accounting firm, both nationwide and locally. We will hold this webinar to approximately 60 minutes. We are going to give you an overview of the basic principles of recent SBA guidance and interpretation. We will also cover some tax aspects and accounting aspects generated because of the recent guidance from the SBA. We'll walk you through an example utilizing the calculator that many of you have become familiar with. And then we will leave the remaining third or so of the hour for questions that webinar attendees can submit via the chat box to the right of your screen. We will go through those questions as submitted. We will group similar questions together in the interest of time and efficiency. And we will try to get through as many of those questions as we can. So to start off the webinar, I just wanted to cover three important points that I think it's necessary for attendees to be mindful of. The first point here is we are here to help you understand how to maximize loan forgiveness under the PPP. There are various steps and methodologies that you can pursue to achieve that, and we will get into the specifics of those in a couple of minutes. And that maximization methodology has been something that has occurred in bits and starts because of the SBA's initial issuance of the legislation and then its subsequent guidance in various iterations. So this is the most up-to-date compilation of the guidance that we've received from the SBA, and we think it'll be very helpful for those of us attending today as you seek to begin thinking about loan forgiveness and how to maximize that. The second point to be mindful of is the various issuance of guidance by the SBA have been in response to feedback that they've received from both lenders, the banks that are SBA authorized, as well as loan applicants, in addition to members of Congress and other constituencies that have been keenly interested in advancing the PPP, satisfying the congressional intent behind it, and how best to help loan recipients put those dollars to work in as quick and immediate a fashion as possible in order to counter the economic impact caused by COVID-19. So to that end, there are really two high-level categories that the most recent issuance of guidance cover. And basically it refers to time and how loan applicants can utilize that time to do two things. One is to utilize the loan proceeds in a more extended period of time, over a more extended period of time. That's for both compensation and working capital purposes. And then the guidance has also given recipients more time to seek loan forgiveness depending upon social distancing requirements that remain in place as states in the country experience reopening and the requirements that are imposed by the various jurisdictions. There's going to be lots of iterations and variations of those themes, but the bottom line is if there are obstacles to satisfying the PPP requirements for purposes of loan forgiveness due to social distancing or reopening requirements, the SBA has attempted to factor those into the formula and the guidance that it has issued to address forgiveness. The third and final point, before we get into the specifics, that we want to make sure that everyone is mindful of is that the PPP was designed to initially start out as a loan, a low interest, extremely low interest, 1% working capital loan that could be used to counter the effects of the economic shutdown in reaction or in response to COVID-19. However, the concept of forgiveness was also built into the legislation, and so that's what we'll talk about today. But oftentimes we, in our experience in counseling clients and others, interested parties, is sometimes there's a tendency by folks to conflate the issues, those two issues, the concept of working capital, a working capital loan, and the concept of loan forgiveness. If, for whatever reason, you cannot fully or in whole satisfy the loan forgiveness requirements under the PPP based on the most recent guidance, you're still in a relatively strong position because you've received a low interest working capital loan. And so it would be great and ideal to have what's called a non-taxable federal grant through loan forgiveness. But if for whatever reason your business does not enable you to satisfy all of the criteria, don't forget that even if it's not completely forgiven, it's an extremely low interest working capital loan that can be used for the permitted purposes and help you get through the storm of the economic shutdown and the reopening caused by COVID. So those are the 3 points we want you to be mindful of as we get into the specifics. And as we get into the specifics now, I'll turn the time over to Josh.
Thanks, Shannon. So as all of you know, in the last couple of weeks, first the House passed legislation to modify the PPP program as we know it. And I was once a Senate page in a prior life when I was in high school. And I like to think of myself as a somewhat keen political observer. And I completely lost all those bona fides when I wrote an email internally to our folks here at Nother and said, here's what the House passed for changes to the PPP. You probably don't need to worry about this because there's no chance that the Senate will pass this exactly as written. And much to my surprise, by unanimous consent, the Senate passed the House bill and it was signed last week. So what are we talking about? What are these changes and what do you have to be thinking about now, especially for many of you who are probably partway or almost all the way through what you originally thought was your 8-week cover period? So what's changed? So the first thing that got a lot of attention was the extension of the maturity date for new loans, meaning anything that has gone out, any new PPP loans that have been issued since this law was signed last Friday will now have a maturity date of 5 years instead of 2 years. That's great for new borrowers. What about those of you who already have loans? My guess, and this is just a guess, and I'd be curious, I know when we spoke about this yesterday, Bonnie was going to ask a few folks in her circle, but I would suspect that if you went to your lender seeking to extend that period, they may be more likely than not to do so, or may do so in connection with the forgiveness process if it turns out you have any amount outstanding after you get partial forgiveness. Bonnie,
and I did speak to some banks, and I know we have some bankers on the line today who might pipe in the chat. But almost every bank I spoke to said, yeah, sure, we would extend the loan if we're approached by the customer, and we would do so at the time of the loan forgiveness application. And I had a few that said not at 1%. So I do have to caution that if the loan is extended, it could be extended with different terms. So that's one thing to look out for.
Yeah, that's very interesting. Thanks, Bonnie. That's really interesting feedback. So it remains to be seen for, I think, probably the vast majority of you out there who already have an existing loan, what this term does to you, but it's there, and it's a conversation that you may or may not need to have with your lender, because if you get full forgiveness, then extending the loan period is irrelevant. So now let's talk about the things that are actually going to get changed, and the one that got the biggest amount of attention, I'd say, is the extended covered period. There's now an ability for you to use your PPP proceeds and analyze the use of those proceeds over 24 weeks instead of 8 weeks. This is, I know from my own conversations, people in the food service industry in particular, I got a lot of questions from those borrowers who asked, well, wait, I can't even open my business. What do I do? So this will be really helpful for companies that were unable to maintain sort of status quo business operations during this time. But you have to be careful, because if you use the longer covered period of 24 months, you will have to do the analysis of your head count and your wages over that same 24-week period. I keep wanting to say 24 months, I apologize, 24-week period instead of the 8-week period. So you'll want to think through, okay, how might this affect me, and what is the business case for how I use these proceeds? It's important to remember that the decisions that you make need to make business sense. One of the other items that got a lot of attention was this 60-40 payroll non-payroll split. So as you might remember from the original PPP, there was a requirement that you had to spend at least 75% on payroll costs, and then you'd have 25% available for non-payroll costs. But under that original formulation, it was not a all or nothing test. It was a loss of forgiveness to the extent that your ratios were off, but just for that excess. Under the current statute as written right now and as adopted into law, the statute reads that it is a cliff. If you do not spend 60% of your loan proceeds, so using the example, if you had $1 million loan, if you don't use $600,000 on payroll costs within the covered period, then you get no forgiveness whatsoever.
So Josh,
yeah.
two questions related to that. It's sure. You have to spend at least 60% under the revised legislation. In other words, it doesn't have to be capped at 60. It's at least 60 in order to qualify. And then secondly, do you anticipate that the cliff could be potentially modified in light of the variance between the initial legislation and the subsequent guidance?
Yeah, that's a great question, Shannon, and I do. Putting back on my political/regulatory prognostication hat, I think the language and the commentary from some of the members of the Senate that was one of the items that concerned them about the House bill, but it was important to them to get these changes made. That I think it's more likely than not that this will be modified in some way, whether it's another congressional action or if there's some way to do it through regulatory action that will turn this back into something more like what we saw under the original formulation, where you'll just lose partial forgiveness to the extent you are below that 60% threshold. But a very good point that you made first that I want to make sure people appreciate is the 60% on payroll is not a ceiling, it is the floor. You can spend 100% of your PPP proceeds on payroll costs, and the SBA would be thrilled because that's the point of this. So a few more things to talk about here and changes. I grouped these together, but it's effectively the idea of broadening the safe harbors. So there were already safe harbors, and we'll go through them in slightly more detail when we walk through the example. But if you had a loss of forgiveness resulting from reduced headcount or reduced wages, under the original formulation, you had until June 30th to fix those issues. That's now been extended till the end of the year. That one's somewhat easy. The next two are a little bit more open-ended, and I think that we're going to see a lot of FAQs, additional regulatory language on what this all means. But the first one is, if you're unable to rehire your terminated employees or hire qualified replacements, and you can prove that you acted in good faith, you can document the efforts that you took to try to rehire these folks, but for whatever reason you weren't able to do so by the end of the year, then you'll get a restoration of forgiveness for that lost employee, basically an FTE exemption, if those facts warrant. And then the second one is, if you were unable to return your business to its normal business levels that you had as of February 15th, which is effectively the date that Congress has chosen as the pre-COVID days. If you can't get your business up to those levels because of your compliance with COVID-related regulations, such as limitations on occupancy or spreading apart tables or other things that have a demonstrable effect on your business operations, then you'll get restoration of forgiveness in that circumstance as well. So again, these are a bit open-ended. It's unclear what is required at this point, but it does, to Shannon's earlier point, try to set forth a public policy that we're doing this in an effort to help people get to the other side of this crisis. And if the way that we have to get there from a safety perspective has a drastic effect on your ability to hit certain somewhat arbitrary thresholds, then we're going to give you a little bit of leeway. The last two I'll go through real quick, but they are important. This deferral on payments tied to final determination of forgiveness. Again, under the original bill, you had 6 months of deferral on payment related to your PPP loan. And if forgiveness hadn't been determined by the end of that 6 months, technically you'd have to start making payments on the loan. And if later forgiveness is determined, the bank would have to pay you back, but you'd have to start making payments at the outset. Now, under the new bill, your payments under the PPP loan won't start until the forgiveness amount has been determined and paid to the bank. So that's a big win for borrowers.
So Josh, there have been a few questions, and we'll get into the specifics of them later in the broadcast. But for the attendees of the webinar, on this point that you just made, there were questions about, if you burn through the capital as prescribed by the legislation, do you have to wait for the expiration of the requisite time period, whether it be 8 weeks, 16 weeks, or 24 weeks, or can you apply for forgiveness early? I understand the genesis of that. They want some confirmation that it's been forgiven. But the beauty of the point that you just made is, even if they don't find out, they could delay until the expiration of the period. They could delay, seek the forgiveness. They're not going to be somehow penalized and have to begin making payments without that determination. And they, in fact, depending upon the backload of the SBA, may have even more time before they have to worry about anything. Is that a fair assessment?
That is a fair assessment. And it's also important to note that you'll have 10 months from the end of your covered period to apply for forgiveness to be able to take advantage of this. So you can't hold on and not apply for forgiveness forever and just have this deferred forever. You have to apply within 10 months following the end of your covered period. And the other important thing to note, and you mentioned this a little bit, Shannon, is this extended period of for your covered period, that's an option as well. You can choose to have your covered period only be the 8 weeks, as it was allowed in the original bill. And there may be circumstances where that's applicable, especially if you've used all your funds at the end of the 8 weeks and you don't want to have to analyze what the next 16 weeks will bring. We'll get into some of the open points real quick on the next slide. And on the last piece, and Bonnie might talk about this just a touch on in her conversation, but PPP borrowers are now eligible for the payroll tax deferral that's included in other parts of the CARES Act. There was sort of a mixed bag as it related to whether borrowers were eligible for that deferral. Now they are out of the exclusion category, so you're able to take advantage of the full aspect of that payroll tax deferral. Bonnie will talk about that a little bit. So I don't want to go too heavy into each of these specific bullet points, but quickly, there are some questions, and this is just probably a subset of what questions remain after the Flexibility Act. But for example, as you'll see in the spreadsheet, and as you've heard from people for throughout this program since it started in July, when you make payments to people for compensation, that's fine, but you could only make cash payments to employees up to a maximum of 8 weeks of $100,000 salary to get that forgiven. So that was $15,385. Well, is it now that you could make cash payments to employees for 24 weeks of $100,000 salary, so about $46,000? Does that work now, even though the loan was based on the 8-week number? Unclear. I read the statute as that being the case, that you could pay an individual employee up to $46,000 and get that forgiven, but that there could be guidance that changes that. And the same construct with owner employees. Are they still limited to 8 out of 52 of their 2019 self-employment income, or 8 out of 52 for $100,000, whichever is smaller? Again, unclear. We talked about this cliff concept, and so will that get changed? I think yes, but wait to see. A lot of questions that I've received, and I know others have received as well, is can we get our head count back up to our pre-COVID numbers to satisfy the safe harbor, and then the next day turn around and fire everyone? Or will there be some covenant established that we have to keep people on board for some period of time? What if I satisfy it before December 31 and then cut back between when I've satisfied the safe harbor and the end of the year? I think there's more to come on that. The short version of it is, to this point, I haven't seen anything that would prohibit you from doing that. And then the last thing that I've seen a lot of questions on, people have asked me, is it that I can only pick 8 weeks or 24 weeks, or can I pick any period of time in between? Unclear. As the person who primarily puts together the actual spreadsheet itself, I'm selfishly hoping that it remains binary, because it was already a pain to build in that optionality, but I'm sure I can figure it out.
So Josh, on these points, these half dozen points or so, obviously we're not giving legal advice via webinar to the attendees, but as a general principle, I think since the advent of the PPP, our position with our own clients has been, in situations such as these, where there's some ambiguity, revert back to the underlying intent of the legislation. What was the Congress trying to address, which is economic payments, or payments that will help facilitate economic activity to business adversely affected by the shutdown. And in conjunction with that intent, we've advised clients to work with their lenders to best determine, as they both can, that intent and how it lines up with examples that you've listed here, and to be relatively aggressive on those points, in the sense that the worst that they can say is no, and they can push back, and then you'll know with clarity where you stand. But the SBA is trying to do too much with too little in terms of its resources and what's being promulgated here, both in terms of the congressional legislation and the actual funds. So being more aggressive than less should at least force a discussion and hopefully inure to the individual loan applicant's particular circumstances and benefit, which we believe ties to the underlying intent of the legislation. I don't know if you have anything to add to that, but I just wanted to reiterate that so that people have that perspective.
I would completely agree with that sentiment. Aggressive but reasonable. Be able to document what you think is what you're entitled to. And exactly as Shannon said, the worst that your lender will say is, this isn't going to work. And then you go back to the drawing board.
I agree.
Right.
I think that the extension to the 24-week period may take some of the things that you would have put in that ambiguous pool, and maybe you don't need them anymore. But to the extent that you do, I agree with that philosophy. And perhaps, like we did at the first go around, we will see a lot of FAQs come out to clarify some of these ambiguities in the next few weeks, or they have even longer now. So we were joking around before the webcasting. It'll probably come out on July 3rd, right before we're trying to have a 4th of July weekend, knowing the SBA.
So, Bonnie, you make an excellent point, and that shouldn't be lost on the group attending today's webinar either. If you step back and look at the big picture here, many of the challenges in the initial legislation with the 8 weeks was you didn't have businesses with line of sight to when they could actually reopen, what type of activity would occur once the reopening commenced, and they were concerned that they wouldn't be able to properly and in the ordinary course compensate the employees to satisfy the ratios for purposes of forgiveness. And so you had the 75-25 breakdown, and then through subsequent guidance, it's become 60-40. But if you step back and look at the movement from 8 weeks to 24 weeks, I think that it's reasonable to assume that Congress and the SBA assumed with that type of extension, the vast majority of loan applicants would be able to get most, if not all, of the loan proceeds into the compensation bucket, which you can have 100% of your loan application or proceeds go towards compensation. It's a permitted use. And then the loan forgiveness calculation is quite simple. It's only a scenario where you can't fit it in the ordinary course during the requisite time period. So hopefully many folks here can fit their loan proceeds, which were based on 2.5 months worth of operating capital, into a period that effectively covers almost half of a year. And that may simplify the process for a lot of folks because they can actually fit it into the compensation bucket.
There we go. So Bonnie, it'd be great to talk about some of the tax aspects of the PPP and other parts of the CARES Act that may have gone a little bit under the radar, or that people should really be thinking about, because they could be just as valuable, if not more valuable, than the PPP.
We could actually have a 2-hour webinar on taxes and some of the changes that the IRS has made as a result of coronavirus. So I'm giving you some tidbits here based on the audience today, what I think is most relevant. When we found, we were telling clients early on that federal taxable income related to the forgiveness. The forgiveness was not taxable, and that was very exciting to a lot of clients. And then when the frequently asked questions came out, and we learned that as a result of that being non-taxable, we cannot take deductions for the related expenses that we pay with the PPP loan. And it makes perfect sense, but my phone was lighting up. I thought you said it was non-taxable forgiveness. So it is non-taxable, but you're not allowed to deduct the amounts applicable to income that's exempt from taxes. So as a result, those covered expenses are not going to be tax deductible. So some other tax tidbits. Net operating losses incurred in 2018, 19, and 20 can now be carried back 5 years, and they can offset 100% of income. So we used to have a carryback claim many years ago, and we haven't had one in recent years, but now we can carry back losses. So if you incur losses due to or for any reason, but even due to coronavirus, you can carry those back 5 years, offset 100% of taxable income. Another change that has been made is you can take an immediate write-off for qualified improvement property assets that were placed in service post 2017. So that's good news for retail and hospitality industries where they have put in place leasehold improvements even in 2018 where they couldn't take bonus depreciation. Now you can go and amend those 2018 returns and get a higher, get 100% write-off, higher depreciation deduction, and you can also do that going forward in 2019 and 2020. And then finally, and Josh spoke about this a little bit earlier, you can defer the Social Security tax deposit portion of your employer payroll taxes, and the payment is not due until 2021 and 2022. And before the new bill, you could defer that tax until you received forgiveness. And then the tax, you would have to start paying the tax again. But now that is no longer the case. You can defer payments through 12/31/2020, even if you have received forgiveness before then. So 50% paid in 2021 and 2022. So those are those are the highlights. There are other things out there, employee retention credits and some changes in the business interest limitations, and happy to follow up with anybody that has questions about any other of the tax acts.
Great, Barney. Thank you very much. And I know that was just a high-level overview, that there's a lot of detail there behind this. So again, we'd recommend that folks reach out as needed to get into the weeds, depending upon your circumstances. What we will do now for the next few minutes is we're going to look at a specific example and highlight the tool, the calculator tool that we've created. Josh will walk you through that, and then once we've completed that example, we will open up the webinar to Q&A based on the questions that we received via the chat room, which have been fast and furious. So I'll turn it back over to Josh.
Thanks, Shannon. And I'm going to apologize right away because you're going to start squinting soon. I'll try to zoom it in, but I just want to highlight the PPP Loan Calculator, which we updated just yesterday based on the Flexibility Act and our interpretation thus far. So we're just going to show a few things here, but to the extent you have any questions, always feel free to reach out to us. We're more than happy to help. So let's see if there we go. All right, apologies already. So this calculator is based on what the current version of the forgiveness application is. We anticipate that'll change, but there's 3 tabs on it, the worksheet where you'll put in your employee data, and then the Schedule A and loan forgiveness form, which pull a lot. So just real quick, you'll see here, you can choose whether you want to use 24 weeks or 8 weeks here, and then you can put in the dates for it to calculate when your covered period will end. You can use, when you calculate your FTEs, you can use a formula-based system, which is how many hours did you pay them per week, divided by 40, round to the nearest tenth. Or you can use a simple method, which is take, look at your employee, did they work 40 hours a week? If so, they're a 1. Did they work between 0 and 40 hours? Then they're a half, no matter how many hours they worked. And if they didn't work any, then they're a 0. And so then we get down to this table, and this is where you'll basically build out the table on an employee by employee basis. And again, apologies, because I know there's a lot here. But you would
Josh, just so we're clear, it's and what the folks should be focused on here as you go through it. The highlighted yellow areas are where the data input would occur. Those are the variables that will change depending upon an individual company's situation, and then they can plug and play the various variables that you've highlighted. Those will tick and tack back up to the basic formula at the top of the spreadsheet, so that ultimately they can figure out what percentage of their loan proceeds are actually forgivable based on these different variables.
That's exactly right, Shannon. And we've tried to build in some ring fences around some of the cells where you can put data in, so that you can't exceed any sort of limitation. So for example, in employee 1 here, I've said that they made $42,000 during the 24-week period. If I tried to type in 50,000 here, it won't let me, because that exceeds 24 out of 52 multiplied by 100,000. And then I'll say if they're salaried, then it blacks out this box here that talks about hourly, just lets me put in my time period here. So you'll put this information
just to highlight your brilliance here, Josh, and I'm saying that with all seriousness. Most lawyers don't even know how to use a spreadsheet, let alone create formulas in it. The beauty of this calculator is, based on the legislation and the narratives that have come in terms of summaries of the legislation, you have built in formulas that accurately quantify and capture it, and then you've also put in governors in certain situations so that people cannot erroneously enter data that would corrupt the ultimate formula for forgiveness.
That was the intent, and to this point, all the tests I've run have come out the way I want them to. So yes. So you'll see here, as you plug in this data, whether they're salaried or hourly, it'll calculate for you what their FTE is. So this person worked 168 days out of 168 days. That's why they're a 1. And then because this table relates to people you have to do an analysis of their wages on, you'll put in information based on their Q1, which is the applicable analysis, and you'll do an analysis here of by how much were their wages reduced. If it's 75% or lower, then you'll go on to the safe harbor analysis to see if you can get rid of that wage reduction. This person here, their wages were 93%, so none of this is applicable. There's no wage reduction. One quick thing, because I've gotten a bunch of questions on this. If you have somebody, in this case, I've got somebody, they previously worked 40 hours a week at $20.83 an hour. During the covered period, their hours were cut in half. They only worked half time, but they still worked at $20.83 an hour. So you'll see their FTE went down to half, but there's no wage reduction. And that's because the analysis is done on an hourly basis, not on a total dollar amount basis. So we're not going to go through every little detail here. You should feel free to download this on our website. It's, I believe, the most recent article on this topic. And you can play around with it. Feel free to ask any questions by email I've had a lot of questions from all over the country related to this spreadsheet. So don't hesitate, happy to help. But I think our time's better spent going through the questions in the chat, Shannon.
Okay, so thank you, Josh. And just one final point as it relates to the calculator. The financial folks, whether it's the controller, the outside accounting firm, the CPAs, the tax folks at each of the various companies will have a familiarity with the spreadsheet and how they function. The business decision makers working together with those finance folks should be able to give input on the various variables that are part of the spreadsheet. And it's more intuitive. The feedback that we have received consistently over the last 6, 8, 10 weeks is that once those teams start to go through the spreadsheet and enter the data based on their specific circumstances, the spreadsheet itself and the formulas that are in the spreadsheet that lead to the ultimate conclusions are more intuitive than they might otherwise initially appear on the surface. It looks like a bunch of cells and a bunch of variables, and it may seem overwhelming. But if you go through on a step-by-step basis, Josh has, I think, created something that's user-friendly, and it should be ultimately valuable to you as you derive that conclusion and as you go through the analysis. As he indicated, if you have follow-up questions, within reason, we're happy to try to address those. Between he and I think we have received probably 50 questions from the 50 states. It feels that way, at least over the last number of weeks, and I'm sure the same is true for Bonnie. Okay, that being said, we're now going to shift to the Q&A portion of the program. We have a little over 15 minutes or so to address those. We have no problem with ending a meeting early. It's never a bad meeting if it can end early, so we'll abide by that principle if it's applicable. I'm going to go through the questions, and I'll pose them to Josh and or Bonnie as applicable, and we will do our best to address all of them. So the first question for the group is, are there any restrictions in hiring family members and paying them with PPP funds? Josh, why don't I throw that one to you?
So there's no specific restrictions. I think it's like we've been talking about, be reasonable. Don't hire somebody just for the sake of hiring them at nothing salary. But I mean, it's as long as there's no prohibition against hiring your family members to be employed in your business. So just be reasonable.
As long as your family employment isn't the PPP Employment Act, and you're acting in the ordinary course, I think you'll be fine there. That's why I agree. Next question is, if we have 350 employees, do we need to list these employees individually, or are there any ways to accumulate them?
Do you want the answer that'll make you happy, or do you want the real answer? the answer is you got to analyze you have to analyze everybody separately. There are two buckets, don't forget. There's the bucket that is people who made over $100,000 on an annualized basis at any point last year. And for those people, you're not doing a salary a wage reduction analysis. They're exempt from the wage reduction analysis. So they're a bit easier to handle because you're only looking at their FTE status. So there might be a group of people you have who've been full-time the whole time. You can easily pull their data and you can probably lump them together. You don't have to deliver that worksheet as part of your loan forgiveness materials under the way that the forgiveness application works. However, you do have to retain a copy of it, and the SBA could ask you for it if it were to audit your records.
And I would guess that if you have over 350 employees, you're probably talking about one of the larger loans, something over $2 million, and which we're not exactly sure what the scrutiny is going to be, and but there is going to be added scrutiny for that size loan. So I would think that you'd want to have your I's dotted and your T's crossed.
And I'll add one small additional thing think about is a lot of the payroll providers out there are already producing reports through their systems that their clients can take advantage of. So, check if you're not aware of whether your payroll provider produces something like that or has some module in what they give you for reports. By all means, you should reach out to them and see if that's something that they can do, because this may make your process a lot easier.
Next question is, we have law students, law clerks who ended their position as scheduled in May. How do we best document this for full-time employment waiver purposes? And I guess that would be applicable not only to law students or law clerks, but other intern type situations and other types of businesses. So what do you both think about that issue?
So I'll give my thoughts on the front end here. I think if the scenario is that you've got some intern who's got a 10-week program, let's say, and it ends, and there is no either you can't replace them, or there is no you choose not to. I think you just have the documentation showing here's what the length of the program was, and they've left, and we're not due to rehire that position for whatever our normal course is, and then you take that position that they fit within the exemption. I think that's as best as you can do.
I agree.
Okay, next question. If the PPP loan amount effectively adds to profit margin, which falls to the partners of an LLC, does that impact loan forgiveness, assuming the loan was spent for the intended purpose over the first 8 weeks?
So the scenario is that because these funds came into the account, the result was there was a profit on the books, and
I think it's okay. Cash is fungible. Yeah. As long as it was used for the intended purpose. LLCs are not a prohibited entity. It doesn't matter where the funds came from, as long as the funds that you received from the PPP were used for the intended purpose. Fair?
I think that's fair.
Bonnie, are you in agreement? Just want to make sure this is unanimous.
I didn't completely understand the question, but no, I agree.
Oh, okay.
The fact that it's an LLC doesn't impact the forgiveness.
Right. The more important point is that it's used for the intended purpose, and then however the chips fall in terms of profitability of the particular entity, that's not an irrelevant fact, but it's not a prohibited consequence.
Right.
Okay, next question. I am the owner of a small retail shop that is sole proprietorship. I have received the PPP loan based on my owner draws distribution, so pass-through concept. However, I have been closed longer than the PPP 8-week payroll period. Can I also file for unemployment?
I don't know the answer to that. Do you, Josh?
Yeah, I don't know the answer to that. So if you're a sole proprietor, then this is income. The PPP loan is income replacement. So I think this is a question better posed to an employment attorney. But yeah, I mean, my gut would tell me you got 8 weeks of compensation.
Compensation through the PPP, yeah.
So the analogy would be if a different company used the loan during the 8 weeks to compensate its employees, and then it chose to terminate those employees at the appropriate subsequent time, would those employees then be eligible for unemployment benefits? And my position there was, yes, they would be.
Yes, but you wouldn't be able to tell them to go home, right? Pay them as if they were working, and have them collect unemployment during the 8 weeks they were being paid.
Right. Not during the 8-week period. It would have to be distinguished, separated. No double dipping, effectively.
Right.
Okay.
Exactly.
Next question. is there any benefit to show expenditures in excess of the loan amount should a part of our expense be disallowed? This is a really good question. And this lines up with, I think, our underlying guidance to clients to be aggressive. My position on this answer would be yes. You can over expense, or not over expense, you can over provide by way of data in both of the buckets. You can show where the funds were spent, and then to the extent that some of those provided expenditures were disallowed, you still would have sufficient buffer potentially to satisfy the requirement.
I 100% agree, and I think the way I would handle it if I was in the position of the borrower is fill the compensation bucket as much as you possibly can.
Right.
And then, and Bonnie brought this up before, the reason that people were asking these sort of little, ticky-tack questions, does this count, does that count, what about this, is because you're trying to figure out how the heck do I spend this money in 8 weeks? Well, now you have 24 weeks, and although there will be some businesses, because of the nature of what's happened to their business, that will have difficulty spending money, I think for most businesses, they should easily be able to spend far more than 60% of their PPP loan on payroll costs if the PPP loan was only based on 2.5 months of payroll.
Right.
Correct. Okay. Next question. If we have, and I apologize for rushing, I'm just trying to make sure we get in as many before we run to the top of the hour. If we have utilized the PPP loan funds as required by the Act, even before the expiration of the 24-week time frame, can we apply for loan forgiveness early or have to wait for the 24-week period? So we addressed this concept earlier. I'll let you answer it, Josh, if you want.
So my take at the moment is the way I read the statute is that it's a binary decision. Either you can have an 8-week covered period or you can have a 24-week covered period. If you choose to have a 24-week covered period, then you have to do the rest of the analysis about what your head count was and whether you reduced wages for the entirety of that 24-week period, even if you've used up your PPP loan in a shorter time period. So you'd have to continue analyzing it. So because you'd have to do that analysis, I don't see how you could apply early for forgiveness. Now it could very easily change. Bonnie, I don't know if you have an opinion on it, but it could very easily change that the SBA says, well, we actually think that what Congress meant was you can pick any time between 8 and 24 weeks.
Yeah, I'm hoping that does change rather than have it all fall at the same time for everybody, because that will just create a backlog, But as of right now, it's 8 or 24.
So the next question is related to this. If an organization determines it can submit an application for full forgiveness after 16 weeks, but not 8, and meets the safe harbor threshold for restoring FTEs and compensation at the end of that 16-week period, do you think a forgiveness application can be submitted early, or will it be necessary to wait until the 24-week period is complete?
Yeah, that's actually an interesting sort of side view of it, right? Well, I don't need to do the full analysis because I've already hit the safe harbor. And
correct.
So whatever happened during the rest of it is irrelevant. That under those facts, it's possible that a lender would allow it. I guess the short version is you'll have to talk to your lender. In the
right.
absence of any guidance to the contrary, you have to talk to your lender.
Next question's an interesting one. I think we all know the answer, but if you elect the 8-week period instead of 24, will the 60-40 still apply, that breakdown?
Yes.
Yep. Next question, is it 60% of the amount of the loan that is used or 60% of the total amount loaned?
Yeah, Bonnie, unless you read it differently, the way I read the statute was the analysis is based on the amount of the loan. So it's 60%
right.
of the amount of the loan, not 60% of the amount you spent of the loan.
Right.
That's correct. That's correct.
Which is
how
different.
Do you recommend
75-25? It was different.
Mm-hmm. Correct.
Yes. There's been a shift there with the subsequent guidance. Exactly. Next question. How do you recommend calculating full-time employees? We were calculating as average headcount for the period. Our payroll provider is calculating based on hours. So 4 weeks at 80 hours calculates the same as 8 weeks at 40 hours for the same period.
So I would recommend that, and I hope this is answering the question as it was asked, but I would recommend that you use the simplified method if your part-time employees are under the 20 hours on average. And if they're over the 20 hours on average, you may want to use the actual hours. And I hope that answers that question.
I think they're asking an even more nuanced question than that.
Okay.
At least that's the way I heard it from Shannon, is do I do it by week or do I do it by payroll cycle in terms of the analysis? I don't know that. I mean, the short version is I'm not sure it will matter one way or the other. It's kind of done on an average basis.
It's going to be pretty close on an average basis, I think.
I do it both ways and see, see if there is a difference.
Take the better position. Yeah, take the better position, anchor to the better position. What if an employee or a group of employees leave on their own? Do we need to replace those employees by 12/31? Short answer.
Short answer is no. You can get an FTE exception for people who leave on their own, so long as you've got the documentation to back it up. If you do fill those positions, though, you don't get a bonus person. So you lose the exception for anybody you end up rehiring.
So Bonnie, I'll give you this softball. If the PPP is forgiven, is it considered a non-taxable federal grant, or will it be considered income per the IRS?
It is a non-taxable federal grant. However, you cannot deduct the expenses that you pay from the PPP loan.
Great. Question related to the non-taxable nature of the grant. Did the new act address the IRS regulation that effectively made the costs covered by the PPP loan non-deductible, thus effectively making the PPP loan taxable? Bonnie?
No, it did not yet. Not yet. So we're still in the same place on that. And the grant itself is not taxable and the expenses are non-deductible.
Great.
Bonnie, would you say it's like New England weather? If you don't like the answer today, just wait till tomorrow. Could be different.
I would say it depends on whether you look at it as the glass as half empty or half full. You still have half a glass.
Josh, that humor cost us 20 seconds. Great. I'm kidding. How are people who are out on disability treated for full-time employee calculation purposes?
I actually saw this in the chat, and I was trying to refresh my recollection on this point. I think that it shouldn't be deemed to negatively affect you. I just don't recall if you treat it as if it's an exception or if you count them anyway. I'd have to look that up again. But I think it's similar to a maternity leave, for example. I don't think that counts against you.
We don't believe it's a penalty. We just have to get confirmation of that, but that was not the intent of the legislation based on what we read. Bonnie, do you know if an easy form for people making under 100,000 will be able to fill out for the forgiveness aspect?
Whether or not they'll be able to file for forgiveness? Yeah, I think that if all of the rules are met for forgiveness, it doesn't matter which form you file.
Just need some type of memorialization of the data, right, for purposes of the form. Can we qualify for the safe harbor for full-time employees if we show that our hotel occupancy is much lower than what was budgeted for in December?
Well, all right. Let me give you two quick answers on it. The first answer for the technical, count the numbers, does it work? That fact would be irrelevant. But with the new, nebulous standard of because of COVID and satisfying the COVID regulations, I was never able to get my business levels back up to what they were pre-COVID. That fact may be very relevant. So if compliance with these regulations is having a demonstrable effect on your business, I would take whatever documentation you can get, financial records, what have you, show how it is affecting you, because we don't know right now what that standard truly is and what you need to prove in order to make it. But that's a relevant fact.
Right, and right, take as strong of a position and as aggressive a position as you can within reason. But if you have something like that, some type of data like that to back up your position, all the better. I think that's the takeaway from that. We have 3 final points here. One is we want to just remind everyone attending the webinar that the calculator worksheet will be posted on the Nother website. It's also included in the follow-up email that you'll receive. And secondly, there was one final question asked within the context of M&A as it relates to PPP loan forgiveness. In the event a company is in the midst of a sale or considering a sale, what should the company, as the seller, be prepared to address with the SBA, their lender, and the buyer in order to move the sale forward? So, very interesting question. I actually have a deal. Josh and I have a deal actually in process right now. There's no black and white answer to this. It creates uncertainty for timing purposes of the closing, because if it's a condition of closing that the loan forgiveness be consummated, then that's going to be an administrative function of the SBA, and it's not clear to us yet how long it will take to receive actual confirmation of loan forgiveness from the SBA. You might receive it quickly from your lender, but then there's a process to receive it from the SBA. We're trying to be creative as to how we contractually address that issue via the closing conditions. You can either delay the closing, not desirable if you're the seller, or you can come up with some type of special indemnity that might factor in the timing of the SBA forgiveness confirmation. Lastly, and we want to remind everyone attending here that Nother continues to be a thought leader on COVID-19 and how businesses and individuals can best navigate these waters. We have an upcoming webinar on June 16th at 8:30 in the morning. It's talking about, through a panel discussion that'll be moderated by Paul Ayub, one of the partners at Nother. It'll be talking about key issues and strategies in terms of transportation and how transportation, both public and private, will be impacted during the reopening phases, both at the state and federal level. So we would highly encourage folks and interested in this topic to attend. We have an all-star panel that will be presenting from various facets of the transportation ecosystem, and it should be a great panel for that purpose. Bonnie and Josh, I want to thank you both for all the time and effort that you put into this webinar. I hope it was helpful to those that attended, and as always, it's a pleasure to work with all of you. Thank you to everyone that attended the webinar, and we will hope to see you soon. Take care.
Yeah, thanks.
Thank you, Shannon. Thank you, Josh.